Welcome to day 2 of a long series in which I will be teaching you how I invest in stocks and some of the things that I learned during my time investing. If you don't know who I am, my name is Aiden Hamlin. I have 7 years of experience trading stocks, cryptocurrency, and bonds. My main goal is to help middle class Americans move themselves into the upper class in the safest, fastest way possible. Moving into what a stock and ETF is. What is the difference between the two? A stock is ownership in one company, aka Apple, for example. If I buy Apple stock, that means I am investing in Apple and Apple alone. Now, a stock is a tool that you use that gives a company the capital to make more money, whether it's to pay their employees or build a new iPhone, whatever the case may be. They need your money. You need their asset so that your money can make money. But the thing with the stock is that you have a higher potential reward versus an ETF. Why is that? That's because you have more movement. With more movement, there means that there's a higher chance of you losing your money versus if you put your money into an ETF. Now, obviously, higher risk equals higher reward. So it's a natural trade-off. Your job as an investor is to understand the difference between a good investment and a risky investment. An ETF is good for long-term growth, exposure to more than one company, and you have less movement. Now, an ETF can be anything. It can be an oil ETF, it can be a tech ETF. So if I have a tech ETF, it's going to be buying more Apple, Nvidia, Tesla, Microsoft. But if I have an oil ETF, it's going to be owning more so of the Exxon and the BP oil companies. Moving into what exactly probability and your chances of winning in the stock market are. I'm actually going to use an example that I did not come up with. This is something that I learned during an MIT course on open software. I'm just going to wait for the TV to pull it up here. Let's say you have two options and you have $1,000. You have $1,000 and you can put it into slot A and you have an 100% chance to lose your $1,000 that you put into the machine. Or you can do option B where you have a 20% chance to win $50. If you had to choose one of the two options, 100% of you are going for option B because you understand that option A is a guaranteed lose. The reason I'm showing you this first is because it brings me into my next point, and it is the most crucial point. If you learn anything from this video, it is this and this only. You need to understand this. Option A and option B have now changed. The parameters in which you are operating have now changed. Option A gives you a 20% chance to win $1,000. You now have a 20% chance to turn your $1,000 into $2,000. Option B gives you an 100% chance to win $50 from your $1,000, meaning you could turn your $1,000 into $1,050. A majority of people are going to go with option A because they are dumb. This is the problem with investors. They treat it like it is gambling. When you invest into a company, you must treat it like you are investing. You are saying, if I had $1 million and I could either keep this $1 million or invest it into the company, based on the information that I have analyzed, I think it is better for me to go with option B or it is better for me to go with option A. How do I do that? What information am I looking for so that I can determine whether or not I should make a risky investment? Well, let's think about it. Here you have stock NVIDIA, and here you have the ETF, VOO. VOO has a lot of exposure to NVIDIA, meaning if NVIDIA goes up 5%, it's going to positively impact VOO. But if NVIDIA goes up 5%, that means that VOO is probably not going to go up as much because it has a bunch of other companies under its umbrella. On the flip side of that, though, when NVIDIA goes down 5%, you're not going to see your portfolio go down 5% because you have your money in a bunch of different assets. it's in Nvidia, Apple, Microsoft, Tesla, Amazon, Meta, you have more exposure, meaning you have less risk.